Hello, I'm Kevin Flynn, and welcome to another edition of Avalon's Market Minute. It's March 24th, 2013. I have good news and bad news this week. The good news is not so much that the markets managed to hang on last week and even go up a bit. That's all right, of course. Nice for stocks to be going up, even if the reasons are a bit dubious. But to make the good news clear, I'm going to have to talk about the bad news first. And the bad news is that they've rung the bell on equities. It is now time to start heading for the exits. The good news is it's only the first bell. And not only do you not have to panic, you will get a chance to sell in an orderly way into a rising market, which when you think about it is pretty good news. The reason I say that the bell is rung is the Cyprus deal, or at least the Cyprus deal as it appears to be late Sunday night. It is not a good one, not at all. Rather than simply come up with the 10 billion euros necessary to keep Cyprus and the Eurozone going, the EU, led by Germany, has decided to extract a very large pound of flesh. They're going to close one Cyprus bank, recapitalize another, and do so by taking haircuts of up to 40% on deposits over 100,000 euros. This is going to be presented as a victory this week, partly for the insured deposits, although there will be some other voices besides mine coming from the backbenches saying otherwise. But stocks are rallying overnight, both in Asia and on the futures markets. The euro is rallying, which in retrospect will be seen as the comic event of the year, but after all is nothing more than another trading reflex. Nonsense. But it's nonsense you can profit from. 5 years ago, almost to the day, the investment bank Bear Stearns failed, essentially for the same reasons as Cyprus was about to fail. It was running out of sufficient capital to fund operations and couldn't get a lifeline. It sort of did, in the sense that the Federal Reserve was able to arrange for most of the bank to be sold to JP Morgan at a price of $2 a share, later revalued to $10, compared to $160 1 year earlier. That's a big haircut. Bear Stearns' collapse was a big warning sign that the U.S. financial system was getting ready to crumble under the weight of its debt. But the markets rose for nearly 2 months afterwards. The S&P rose almost 10% in that period, and then didn't see that level again for over 4 years. Cyprus is sort of getting a lifeline too, but one that utterly crushes its economy. Like Bear Stearns, the building will still be there, but the rest is history. And like Bear Stearns, the damage goes well beyond the dollar value that is, after all, fairly small relative to the larger economy. But the Bear Stearns fall started the march of money into safer places. Afterwards, all of the other banks found it more and more difficult to fund operations or to raise capital. The follow-on effect of the Cyprus penalty will be similar. It will weaken all of the next weakest banks throughout Europe, as investors wonder that if they could lose 30 or 40% of their money there, where else might it be? Spain, maybe? Portugal? It probably won't cause a run on the banks any more than it did in 2008. Rather be a process of slow starvation of the weaker ones, perhaps on a national level or a regional one, who find themselves, like Bear, unable to have enough working capital to meet losses and minimum capital requirements. The Cyprus decision is being driven partly by electoral politics and partly by a conviction that this was an opportunity to punish evil money, in this case Russian. We were in the same place 5 years ago. A big election in the fall, and Bear Stearns not exactly a beloved bank. Don't believe in the victory rhetoric and rally that will follow, though. It's just more short-term trading noise. It will be seen as proof that the bureaucrats are on the job, but it will mean a weakening of the weaker members in the Eurozone. And like the US government and the Fed in 2008, there is no exit strategy in place, nor the will to have one. The EU is in recession, just as we were, without the desire or collective will to spend the money to fix the problem. Sometime later, almost certainly this year, something will crack. There will be a credit problem. And the odds are quite good that we will see a violent reaction in the financial system. The only question is when. But the good news is that they have rung the first bell, and this gives you a chance to start moving out in an orderly fashion. If the Cyprus decision goes through as advertised, I would look to scale out of equities on strength and add to treasury or gold positions on weakness, but more the former, as gold and silver didn't do so well in the 2008 crash. We won't escape the EU shockwave any more than they escaped ours. But it's only the first bell that's rung, and we have a nice rally to sell into. And when you think about it, that is good news. I'm Kevin Flynn, and thank you for listening to what was rather a long Market Minute.